In this week's video, we're going to look at the performance of asset classes over the quarter and more importantly over the past 12 months. We'll then turn to look at equity sectors for Australia and also an overview of global activity indicators and earnings trends for the past 12 months. So we'll just start off with a look at the asset class performances. We're showing here asset classes, we're showing the ASX 200 here at the moment, beginning June 30, 2015 through to the end of the financial year. So over the financial year, Australian equities returned a very mediocre 0.6%. You can see the pattern of returns, a strong pickup from about February, March into the end of the financial year. However, it didn't really matter that much what asset or what equity asset class you actually held. If we look at the performance of global equities in Australian dollar terms, ex-Australia, you can see there basically a similar performance at the end, although Australia actually outperformed in the last, say, 3 to 4 months of the financial year, but they ended up both up about 0.6%. And even on a hedged basis, although we don't have the data from last night just yet, but that'll be very close to the numbers achieved both unhedged global equities and also Australian equities. So a very poor year for equities, flat, basically the same across the various markets. Where you did get stronger performance in equities was from small caps, and small companies actually returned about 14.8% for the year. Very strong performance in the last 4 to 5 months of the financial year. So where did the stronger performance come from? What asset classes outperformed? Well, we only really have to look at REITs. And we'll just have a look at the REITs number up here, and you can see there A-REITs produced returns of around about 25%, a consistent, very strong performance over the year. We also had quite strong performance from Australian bonds, as we see here, introducing those. That's now the purple line. Australian bonds, consistent performance, ending up 7% over the course of the year. What about just the past 3 months? So if we just take this forward to the end of March, you'll see here the various performances. So once again, property trusts producing about a 9% return over the 3-month period. That was followed by the green line, which is small caps doing around about 6%. And that was followed by global equities in Aussie dollars and the ASX 200, both of those doing close enough to 4%. So it was a reasonable quarter, but to an end to what was a very disappointing year for equities at least. We should also mention the performance of high yield and emerging markets. Just using high yield index, adding that's the gold line. So that did a very similar return to that of domestic equities and global equities in Aussie dollar terms. So you can see there also quite a poor performance, although a strong performance in the most recent 3 to 4 months. And finally, adding emerging markets. We'll do that in Australian dollars. Now, emerging markets ended up down for the year in Aussie dollar terms by about 11%. Once again, that performance troughed in that February-March period. So a reasonably strong last 3 months of the year where emerging markets in Aussie dollars did just under 3%. And in fact, in the most recent month, added about 0.7% compared to global equities in Aussie dollars down 3.6 and the ASX 200 down 2.5. So they finished the financial year in a stronger position certainly than during the middle part. Now I want to turn your attention to equity sector performances. And once again, the divergence was quite extreme across the various sectors. So and obviously they're going to have picked up on some of the themes that were evident at the asset class level. So as we already mentioned, property trusts producing returns in excess of 24% over the 12 months to the end of June. Likewise, you'll see that utilities also produced returns of around about that level. That's now the red line. Other defensive sectors within the market also did well. Food and beverage stronger during the early part. It still ended up say 24% for the year overall. So a very strong performance, but it wasn't all about defensive sectors and interest rate sensitive sectors doing well. In fact, our own domestic cyclical sectors performed quite well. Retailers, that's the green line, they actually produced returns of around about 20% for the year. Media also produced quite a solid return, getting up around about 17 or 18%. So it wasn't all about being in the defensive or in the interest rate sensitive sectors. Domestic cyclicals did well, as the domestic economy perhaps did a little bit better than expected, and the RBA cut rates. Of course, the other major performing sector was pharmaceuticals and healthcare, producing returns up around about 30%. So let's look at some of the poorer performing sectors, and it's no surprise that energy down a little bit over 20% for the year, although it stabilized after the big sharp fall late last year. It pretty much stabilized. Likewise, materials overall troughed in that February period and actually ended up the year almost unchanged. So that was a strong bounce out of the materials sector. And banks, and these together, these sectors comprise getting close to half the market. And so banks actually produced once again a very poor year, down by around or very close to 10% over the period. So so that's the overall performance picture for the Australian market over the course of the year. What about on the global economic activity front? Well, we all know that the global economy is facing a number of challenges at the moment, whether that be just a lack of confidence, a lot of uncertainty now, more recently political uncertainty. But let's have a look at how the year transpired for the various key indicators across the various regions. So let's first consider the US. I'm using the ISM manufacturing index here, and you can see it started the financial year around about 53, troughing down at 48 in January before putting in a recovery over the second half of the financial year, although this is a little bit of a concern, the most recent loss of momentum. It is in expansion zone, but only just. If we look at the US service sector ISM, that has been quite strong, although that too has been on quite a consistent downtrend over the course of the financial year. So it's now at its lowest levels, in fact, for the financial year. We'll get another reading out in the next couple of days. Just going around the globe, European PMI, that's now the gold line. That was pretty steady at around about 52, briefly dipped below 52, but not much happening there. The Japanese manufacturing PMI has been quite disappointing, dipping from about January, February onwards, and that really coincides with the strengthening of their currency over that period. So the Japanese economy, particularly the export sector, getting hit, and that's showing up in the PMI. Chinese PMI, this is the official PMI, that's coming up now as the purple line. That too has been very flat, basically at 50 for the whole year. The more heavily weighted towards the private sector PMI for China, that has now come up in the light purple. I might actually get rid of some of these others so we can see that a bit more clearly. That now is the red line. You can see there that had quite the sharp downturn in the latter part of last year, when the concern was at its greatest over the Chinese economy and the threat of devaluation. We saw quite a nice little pickup in the early part of this year, although that too now looks like it's lost some momentum. So finally, look at the domestic indicator. We use the NAB Business Conditions Index, and that's, although we don't have the history of it going back pre-2015 on this particular chart, but it is pretty much averaging around about 10. It's been fairly consistent, say, for a brief downturn as the global economies were turning down in the early part of this year. So a fairly solid, consistent performance from our own domestic economic indicator. So let's finish with a look at the earnings picture. What we're looking at here is earnings revisions for each of the major regions over the 12-month period. So you can see here in this chart, I'm looking at the S&P 500, and I'm looking at FY1 earnings growth estimates. and 0 to 12 months. So that's at the beginning of FY1, and that's basically as we get out here, that's at the end of that financial year. So you can see how earnings get revised over the course of the year. The current starting point for earnings for FY 2016, the US is quite low. You can see they're down around about 1%. For Feb 2015, it was sort of similar levels, and you can sort of compare where earnings estimates were in the previous 4 or 5 years. If we look at FY2 for the US, so this is sort of 2017, this is interesting. The market still, and this is using IBIS consensus data, it's still got earnings growth for the following year of around about 13.5%, and this is not unusual. Typically, over the past, say, 5-6 years, the average has been around about 12%. But look, what's interesting is that around about halfway through, or slightly before halfway through that FY2 period, we've seen fairly substantial downward revisions. So I guess the question is, are we likely to see the same again? Certainly, that's been the pattern in the post-GFC period for FY2 earnings to be downwardly revised from about the 4 or 5 months in. Going across to some of the other markets, European FY1 earnings growth, you can see there, we're sort of 4 months into the financial year. They're basically slightly negative, and the trend over the recent 4 or 5 years has always been in the same direction. We should have FY2 for Europe. They've got quite strong earnings numbers, expecting a turnaround in earnings over the course of the next 12 to 18 months. And you can see that there, sitting up around about 14%. But similar to the US, the history has shown that they've been revised down. For Japan, FY1, we're looking for a bit of growth there. I think perhaps if we look at FY2 for Japan, the numbers probably looks like there's some oddities going on within those numbers. What about for Australia? Well, emerging markets, we'll do emerging markets first. Emerging markets for FY1 sitting at around about 6%. Similar to the others, the trend has typically been down, and for FY2, looking at 14%. So it's a fairly consistent pattern across markets. Modest earnings growth this year, particularly in the US. Expectations of a fairly solid start for the following financial year, which, if history repeats itself over the past 4 or 5 years, they will be revised down. Now, we'll just finish then with the Australian numbers, and we use a June financial year. So look at FY1 for Australia, and you can see those they've come down to about -14, -15%. I suppose FY2 is going to be more interesting for Australia, and FY2, those numbers were sort of sitting at around about 6%. So overall, the picture for earnings, it remains quite modest for the next 12 months, particularly in the major markets, US, Europe, and Japan. Although the expectation likely to be disappointed is quite strong earnings in the following financial year. Thank you.